Rising property prices are creating a wealth effect. Consumers are feeling more comfortable and they're spending. They're spending on big ticket items, they're spending on vacations, and that's having positive effects on our economy. We're going to be discussing that, plus some of the latest property and unemployment and economic statistics in this week's Property Insider video with Dr. Andrew Wilson. If you want to keep up to date with what's happening in our property markets and our economy, please subscribe to our YouTube channel, and if you want to be notified each week, just click the little bell icon. An interesting side effect of our rising property prices around Australia is the fact that luxury car sales are also booming. This is caused by what some people call the wealth effect. We feel good when the value of our homes increase. In fact, the Reserve Bank counts on the wealth effect of rising house prices caused by the lowering of interest rates to drive spending and to boost our economy. If you think about it, that makes sense. When we feel more comfortable about our finances, our jobs feel more secure, we feel secure about our future, we're likely to spend more. In particular, we're more likely to spend on big ticket items like new cars and upgrading our homes. Interestingly, this week, the CommSec Luxury Car Index, which tracks 19 luxury cars like Porsche, Aston Marti, Bentley, Mercedes, Jaguar, this index now clearly shows luxury cars are growing in tandem with rising property values. In fact, both of them increased 5 months in a row. Of course, when we feel wealthy, we also splurge on other discretionary spending. We feel we deserve it. And interestingly, the new Treasury analysis shows that our economy grew by $7.5 billion in the December quarter alone due to people holidaying at home and spending our money here in Australia rather than abroad. So while some sectors of our economy are still continuing to do it tough, overall, the economic turnaround we've had in Australia has been unprecedented. Now, that's a word we were using last year when everyone was talking about the negative effects of coronavirus in our economy. So to get a better informed perspective of what's happening in our economy and our property markets, I'm looking forward to this week's Property Insider chat with Dr. Andrew Wilson, Australia's leading housing economist and chief economist of My Housing Market. Hi, Andrew.
Good morning, Michael. And it is interesting, those statistics on new car sales and luxury car sales. It's also interesting, part of the consequence of the shutdown, the pandemic last year, was that we've seen also used car prices are rising now, which is quite interesting. And one of the reasons is a shortage of new cars because, of course, during the shutdown, a lot of the manufacturing for new cars came to a halt. So once we've sort of got the bounce back, particularly in Australia, and there is demand for new cars now, as you suggested, and luxury cars, there's not the supply to meet that demand. So there's been a switch, of course, through necessity to used cars, particularly higher priced used cars, because with all this positive consumer vibe in our economy, we're now running into supply shortages with those discretionary spends. So that's quite interesting. So used cars are now part of the recovery phase of the economy.
And so are caravans, Andrew. It's hard to get a caravan. A couple of friends of mine have been on the waiting list for quite some time for caravans.
Anyway, it's the way it goes, swings and roundabouts. The essence of economics is it's about the study of scarce resources. We basically have in any given time a fixed quantity of resources. So if we do get interruptions to that, that's when we do get those disruptions to the supply and demand outcomes. And that usually ends up with either higher or lower prices. And that's what we're seeing now as we sort of readjust back into hopefully a more longer term reality with our supply and demand levers.
Which leads us beautifully into what we normally discuss at the beginning of these sessions, the auction clearance rates. We had a bit of a break over the holiday season, Easter, school holidays, a bit of a distraction. But auction markets performed very well last weekend, Andrew.
Yeah, look, there was some, chat that the weekend after the Easter break, where we did see this year so far low clearance rates in both Melbourne and Sydney, that might signal the end of the boom. But the markets have bounced back. And as we discussed last week, Michael, this is typically what we do see during the autumn holiday period, that we do see lower clearance rates from lower volumes. And particularly in Melbourne, that's a product of fewer higher priced homes offered for auction during that holiday period. And that's why typically we see downward pressure on clearance rates during that 2 to 3 week post-Easter holiday period. But school holidays are over now, Michael, and we did see, I guess, a return to a sense of normality in auction clearance rates at the weekend. Sydney, it was almost, I was that old, Sydney had an 86% clearance rate, which is a month ago would have been shouted from the rooftops, particularly a year ago, or any other time it would have been shouted from the rooftops as a phenomenal result. But of course, it was lower than those plus 90% results that we've had over the past month consistently prior to Easter, but still a very strong result. And the other thing was it came from a substantial number of listings also, Michael. The sellers are still quite happy, and why wouldn't they be, to engage the marketplace. It's the same in Melbourne, even though Melbourne's clearance rate again was under 80%. It was from a higher volume of listings this weekend. And I think, again, we've got to put in that disclaimer for Melbourne that slight falling in clearance rates definitely was a reflection of still some holiday distractions. But we do come back to the more normalised markets coming up now. We move into the second part of the autumn selling season, the run up to the Queen's birthday, which typically signals the beginning of the winter recess, if we could call it that. So, look, I expect clearance rates to start to moderate. I think even if it's just the greed factor where vendors are deciding to pass properties in because they feel they can get a little bit extra in the negotiation process after an auction, and that can tend to happen and push down clearance rates marginally. But it's almost what we would say it's unsustainable. But there's still a lot of life left in our housing markets, Michael, and I would suggest that it's almost certain that we're going to continue to get a strong to solid growth through particularly the next quarter or 2 quarters.
Lots of other good news as well in our economy. It's almost like the auction clearance rates where every week we keep saying they're high, they're going up, prices are going up. We talk about the same with unemployment, but in the other direction, unemployment's going down and jobs keep being created. Recently, the unemployment rate fell again. Now, JobKeeper ended, so it'll be interesting to see what happens with the next set of statistics. But so far, it's looking good, Andrew.
Yes, another fantastic result for our labour market, Michael. Over March, we saw the unemployment rate fall down to 5.6%. Interestingly, now we're within, I guess you'd say, spitting distance of where we were prior to COVID. We may even start pushing below 5%. Who would have believed that? The Reserve Bank will be very happy. But certainly, I think most of this year will be a 5, with the prospects certainly of lower, not higher. We would have already started to see an adjustment, even though JobKeeper was still in action up till the end of March. We would have seen adjustments occurring as those, knowing that they would lose their JobKeeper allowance, had have moved into the workforce. And I think that jobs growth is strong enough now to offset any negative impact from the end of JobKeeper. And I think when we look a little bit closer at the figures, there's some sort of positives and perhaps not so positives in the data. First was that most of the jobs that were created were part-time jobs. In fact, we had a loss of full-time jobs over March, and that's a reverse of the previous February where it was all full-time jobs. Nonetheless, I think that shows perhaps some of that adjustment process from the end of JobKeeper, that there is a surge in part-time work, those that are moving off the government support programs and are getting work, which is obviously on offer to be able to create a very strong result for part-time jobs over March. So it remains to be seen the full impact of JobKeeper, which will be revealed over the next couple of months. But I think it'll be negligible, and because the offset is how strong the economy is growing now and how a positive confidence is both from consumers and business. The other point that was very interesting, Michael, in the unemployment stats was the participation rate. Now, the participation rate reached a record high. Sometimes you can get a low unemployment rate because the participation rate is falling. That means the proportion of people of the population in the workforce is actually falling. Now, if it falls, it can actually mean a lower unemployment rate because your actual basket of labour is declining. But when you're getting a lower unemployment rate with a higher proportion of participation from the population in the workforce, that's a plus because it means that you're able to find jobs for a larger proportion of the population at an increased rate. So fantastic news, really, a record participation rate and a sharp fall in the unemployment rate. So we really can't find any negatives other than perhaps that shift to part-time work in the short term, but really that does readjust from the previous month. But when we look just quickly at the state figures, Michael, we can see that Western Australia really is a boom economy at the moment. Its unemployment rate does have a 4 in front of it now. And a lot of the Western Australian economy is being driven by the Perth building boom, and that's home building. It's a remarkable new home construction cycle going on in Perth at the moment, and that's a significant force in the labour market, as it typically always is. Residential construction is very labour intensive. Now, Perth or Western Australia has the lowest unemployment rate. Sydney next, it fell. But the only state that went against that, Michael, was actually Victoria, which had an increase in its unemployment rate over February. But when we look at the participation rate in Victoria, it actually increased quite sharply. So there's a little bit of that, I guess, the insight that a higher participation rate can actually mean a higher unemployment rate, because you're having to find jobs for more people that are coming into the actual workforce. But overall, with the perhaps exception of Victoria, it was a great month for the labour market, and more to come, notwithstanding that we're now past the JobKeeper so-called cliff.
Yes, another cliff we didn't fall off. You mentioned about construction, Andrew. In March, the sale of new homes soared 90.3%, the second strongest monthly result since 2004. Buyers were rushing in to get into the end of the home builder grant. But recently, the federal government extended the start of construction for home builder grants by 12 months. They extended the deadline. It gave builders until September next year to begin work rather than September this year. It's just going to take some of the pressure off, because we've already mentioned about the shortage of material, the shortage of skilled labour. This is going to push up construction costs. But there's no doubt home builder did its job. It was a very successful incentive.
Yes, Michael, and in terms of the cost implications for this very strong surge in house buildings, particularly, of course, because it's not going to have much impact on the unit market, but because that has a completely different supply profile, we're not going to really see any cost implications until we get on the ground in terms of starts. And that's when we will get material and labour shortages, which are sure up the cost of building. So we've got some time to go before that actually evolves, because we haven't really started the building at all. But when we do, that's when this surge in supply will have an impact on higher prices through shortages of labour and material. This is the problem always when you have these hits to a particular economy or a typical market sub-economy. You can get these disruptions to particularly prices, because it's not a sort of an orderly process of being able to increase supply because of the predictive nature of demand. And as I said, this has just sort of fallen a huge heap at one time, and it's going to mean shortages, and it will mean higher prices. Now, the other thing is, Michael, just sort of correlating to that, I thought you might find interesting that I measured the asking prices for new houses between February and now in the middle of April. So that's over the last 2 months, to see if we've had any significant change in asking prices for new houses. This is new houses.
Yeah.
Actually seen a 2% increase in New South Wales for the asking price of new houses, and a 4% increase in Victoria, which of course is the epicentre of new house building. So prices are already rising for new houses that are for sale. These are asking prices. However, Queensland was steady over the last 2 months for asking prices for new houses, and actually Western Australia was down marginally by 1.1%. So some interesting, obviously, upward pressure already on the asking price of new houses.
Well, people selling new houses recognise that there's strong demand from first home buyers, and there's also the stamp duty and other government incentives to encourage them to get in the market. And that's good that more Australians are getting on the property ladder. In fact, it's good that more Australians are feeling comfortable now. They're more optimistic about their future. And week after week, the ANZ Roy Morgan Consumer Confidence Index keeps rising as well. It's almost a 17-month high. But what I also liked to hear was that the CBA household spending intention series rose. Combined, these figures have got positive implications for our economy moving forward.
Yeah, and just to finish off, Michael, we've also got the stock market now back higher than where it started at COVID. So the All Ords is now higher, and these things fluctuate, of course, but it has had a daily finish higher than the highest daily finish prior to COVID. And the good news for there is for superannuants, of course, because that'll mean we're basically superannuation returns are just a reflection of the stock market. And with superannuation dividends, dividends increasing now, so they'll boost confidence even more, I believe, Michael. But we await the budget, which is coming up soon, and that'll be interesting to see if there are any further injections into the economy, as we had obviously last year to overcome COVID, which has been, I guess, on anybody's measure, a pretty good success.
Well, the latest estimates are suggesting the budget deficit isn't going to be anywhere near as big as expected because of this spectacular turnaround. So that's coming up soon. We're also going to keep getting a lot of this good news. So I look forward to having a chat with you again next week, Andrew.
Yes, thanks very much, Michael.